Hello and welcome to this special edition of The Global View. I am Anisha Jain and I have a very special guest joining me today. He's not only a bestseller author and a distinguished financial journalist, but he's also the guy who's come the closest that is humanly possible to cracking the investment code by speaking with the best, the biggest and the brightest there is in the world of financial markets. It's a pleasure to welcome on board William Green, the author of Richer, Wiser, Happier. William, hi. Thank you so much for speaking with ET Now. It's an absolute pleasure having you here.
Hi, Anisha. It's such a pleasure to be with you. Thanks for having me.
Fed outcome, inflation print, recession or no recession is outside the control of an investor, right? How much credence, let's say, Warren Buffett or son John Templeton give to these external, uncontrollable macro data points?
You raised such an important point there, Anisha, because actually, if you look at the greatest investors, almost without exception, the ones I've interviewed don't pay that much attention to macro questions, because what they're saying is, actually, all this stuff is unknowable. And you think of somebody like Howard Marks, for example, who I write a chapter about. Howard oversees something like $163 billion at Oaktree Capital in New York. So this is one of the great investors of our time, one of the most powerful, most influential investors of our time. And Howard says, look, I belong to the I don't know school. I don't know what's going to happen with inflation. I don't know what's going to happen with economic growth. I don't know what's going to happen with unemployment. And he says it's all too complicated. There are too many factors. And that makes total sense if you think about it. That just think about the midterm elections that we just went through here in the US. Nobody predicted what was going to happen. Everybody was saying, well, there's going to be a Republican wave and the Democrats are going to be crushed. And in fact, it hasn't turned out like that at all. Think about COVID. Nobody was predicting that we would all end up having to stay at home and that the economy would be turned on its head because of some virus that appears to have come from, bats infecting humans in China, and then it spreads to the world. We don't even know if that's really what happened. The world is such a confusing and complex place. And so, in a sense, once you understand that it's not that helpful actually to make predictions about macroeconomics, you can actually focus on the micro, on what is knowable. And so the common denominator of investors like Buffett, like Munger, like Howard Marks, is that they're saying, well, let me value a business, let me value an asset and see what it's worth. And then let me try to buy it for less than it's worth. And this to me was a total revelation. Once I figured out, oh, that's what they're doing, it's incredibly liberating because you can say to yourself, well, so I actually don't need to play this game of pretending that we can predict the future with all of us, which all of us in our hearts know is impossible. And so it just frees you up to say, let me focus on what's really important, which is trying to value assets, trying to figure out whether this is a good business, whether it's cheap, whether it's going to generate great cash flows in the future. And so it's a difficult thing for a regular investor to figure out because there's so much noise, there's so much prediction around. It's just this game that suddenly you realize is nonsense and you have to tune it out. But it takes a degree of discernment and education to get to a point where you realize most of what people are talking about in investing is nonsense. It's a waste of time. Forget about the macro. It's not that it's irrelevant. It's very important, but the problem is it's not knowable, at least not to the greatest investors I've interviewed. And I figure if Buffett can't figure out what's going to happen with the economy or inflation or growth rates, why on earth would I delude myself into thinking that I could figure it out?
Well, this brings me to my next question. George Soros famously said, I don't like working. I do the absolute minimum that is necessary to reach a decision because there are people who amass an inordinate amount of information, much more than is necessary to reach a conclusion, and then they become attached to these investment decisions. Is this a common trait that you have seen across the big investors as well? They're this passionate and keep it fairly simple when it comes to investment decision making?
The investors I've interviewed have an extraordinary gift for simplification, for looking at this very complicated world and focusing on what's most important. So one of the most famous investors I've interviewed is a hedge fund manager called Joel Greenblatt, who has this astonishing record. He made 40% a year over 20 years at his hedge fund, which means that basically you turn $1 million into $836 million. It's an extraordinary feat. And I went to interview Joel Greenblatt multiple times. And one time I'm sitting at his house in the Hamptons, in this beautiful house overlooking the ocean here in the US. And I said to him, so Joel, what's the secret? How did you do it? And he says, look, William, it's so simple. He said, it all comes down to this. He said, the whole game of investing is to value a business and buy it for much less than it's worth. That's it. So this, again, it's this very essential truth about what investing is really about. But it raises a really important question. So what Joel Greenblatt said to me is, you have to actually ask yourself a very honest question, which is, do I know how to value a business? Am I equipped to play this game? And so what Joel said is, if you're picking stocks without actually knowing what you're doing, without knowing how to value businesses, he said, it's like running through a factory, a dynamite factory with a lit match. He said, you might survive, but you're still an idiot. And I took this very seriously because the truth is, I love investing. I'm passionate about the principles of investing. I'm fascinated by the psychology of great investors. But I don't really want to sit around analyzing companies. I don't really want to sit there going through financial statements. And the truth is, I'm not really capable of it. I can count to about 7, and I have no accounting skills. I'm a writer. And so one of the greatest lessons that I've learned is that I just have to be self-aware enough to say, I'm not really equipped to win this game. I should stick with games that I can play. And so one of the games that I can play is to outsource my investment decisions to people who are smarter than me and more rational and have more training. Another thing I can do is to say, well, let me just buy an index fund, a tracker fund that just invests in the stock market in a very diversified, very low cost way. And so that's a very good default option. But I think most investors are not honest with themselves about whether they're actually equipped to win this game.
Well, William, I guess this is exactly what has played out in the crypto world as well. We have seen the recent carnage, and I'm sure all of us at some point of time had that FOMO moment, the fear of missing out, and we try to jump into these fads, whether NFTs or cryptos, etc. But tell us, how do you differentiate between, let's say, an ahead of the curve trade versus a fad?
Many years ago, about 22 years ago, when I first got obsessed with investing and went to interview Sir John Templeton in the Bahamas, he talked to me about what actually successful investors need to understand. And he said, look, the first thing is you have to avoid fads. You have to avoid getting carried away by crowd behavior, herd behavior. And he helped to republish a classic book that has the most wonderful title. I think it's about 200 years old, something like that. And it's called Popular Delusions and the Madness of Crowds. And this is something that's been going on since tulip mania back in, I think, 17th century Holland, that we fall for these fads, we get carried away. And you see it over and over again. It's one of the most important things for investors to avoid in order to survive and prosper. Just to say, what's the herd doing? What's the crowd doing? And then just to be extremely careful, especially when you feel this sense of yearning, this sense of jealousy, this fear of missing out that you mentioned, when you feel it rising and you start to say, gosh, I can't believe all of these idiots are making so much money overnight on cryptocurrencies. Why can't I get a piece of that? And I just think that's such a dangerous emotion. And so I try really to stamp it out in myself. I wrestled over and over again with whether to invest in Bitcoin. And I would interview all of these great investors. And one of the things that Joel Greenblatt said to me is, look, I don't need to play that game. He said, I don't know if Bitcoin is going to go up or down, but that's just not my game. I'm going to stick to my knitting, which is to buy inexpensive, high quality businesses. And that to me was, again, very liberating to think you don't actually have to play this casino game in order to get rich as an investor. And in fact, the thing that I've discovered over the years is often the slower path turns out to be much faster in the end. All those people who were approaching investing as a casino, rolling the dice, buying cryptocurrencies like Solana and the like, and Ethereum, and thinking, yes, I could make 30% in a week. How are they feeling now? And the people who were quietly buying cheap stocks, quietly buying things with a margin of safety that were undervalued, those people are all sitting pretty now. They're all fine. And so I think you just have to discipline yourself. You have to have the ability to separate yourself from the emotions of the crowd and say, does this actually make sense? Do trees grow to the sky? Have people just invented this permanent money-making machine where some asset is just going to go up and up and up and forever. And in my experience, that's never been the case. Sanity always reasserts itself.
William, I'm intrigued to know your view of where we are in the market. We have seen these wild swings, we have seen the market crash, we've also seen the big layoffs, etc. Would you say we are in that moment where the likes of Katie Wood, etc. are seeing everything on a fire sale? Or is it a market where Warren Buffett and Charlie Munger would say, wait, let the uncertainty die down before I take a plunge?
One of the great insights from Benjamin Graham, who was Buffett's teacher and mentor, is that you want to make the market your servant and not your master. And so people who make the market their master are being yanked around emotionally by whatever's happening today. They panic when the crowd is panicking, and they get carried away when the crowd is excited. And what Ben Graham said and what Buffett said is, no, it's the opposite. What you want to do is look at the market and say, okay, I'm going to make this my servant. And so at the moment, if the market is very tempestuous and there's a lot of fear and there's a lot of uncertainty about the economy, about the war in Ukraine, about inflation, all of these problems, environmental change, that actually, for the best investors, is probably good news, because that uncertainty, that volatility creates mispricings. And so what the best investors are doing is they're not saying, I know which direction the market is going, because as we said before, none of us can predict that. But what they're doing is saying, well, when the crowd is panicked or overexcited, it creates inefficiencies, it creates mispricings. And so what Charlie Munger said, which I love, is that he has this beautiful image where he says that an investor should really be like a spear fisherman. And he says the spear fisherman is standing by the side of the stream, waiting for a big, fat, juicy salmon to swim by. And he said, once in a while, a big, fat, juicy salmon, a really undervalued asset, swims by, and you spear it. And then he said, you go back to waiting, and it may be 6 months before another big, fat, juicy salmon swims by. So this period actually is a tremendous opportunity, if you're smart, to look at the companies that you really loved that were too expensive to buy before, and to say, well, is it now cheap? But again, it gets back to the original problem that we discussed, which is you have to be qualified to buy that, to value those assets. And if you're not, you shouldn't play that game. But you can at least say, well, I know that the stock market is cheaper than it was before, so why don't I put some money in a fund? Why don't I put some money in an index fund? And I'll just keep adding to it. And I think this is one of the smartest things that any investor can do, is during times of tumult and fear, just to keep adding to the pot. The dumbest investors, the least successful investors, panic at the worst time and sell when there's fear in the market. The smartest investors tend to keep holding, keep buying, keep adding to the pot.
Hold that thought, William. It's time now to slip into a very short break, but don't go anywhere. We have lots lined up in this interesting conversation with William Green when we come back. Welcome back. We're still in conversation with William Green, the author of Richer, Wiser, Happier, and we were just discussing how one should wade through this volatility. Well, William, the other big misnomer is trying to time the market, right? Both in terms of entry as well as exit. I know Buffett famously says our holding period is forever, but more practically speaking, for our viewers, what's the best way to manage the timing conundrum?
No, I think timing the market is totally futile, because not only do you have to be able to figure out when to get in, but when to get out, and then when to get in again. And in my experience, you're just better off staying in. When I look back on my investing career, I think the biggest mistakes I made were when I was overreaching, when I was in a hurry. So for example, I had a few opportunities to invest in private companies. I used to live in Hong Kong, and I had this opportunity to invest in a private company that had amazing technology. I got super excited. I felt like I was special. I was part of the rich, important set that got access to this stuff. And I lost most of the money that I invested in that private company. I mean, it was just an absolute disaster. And I've had this happen 2 or 3 times. And I think things that have worked out better for me on the whole were just when I was much more patient, when I put my money in a fund and I just said, this is permanent, basically. I have a friend, Guy Spear, who I know has been on ET now several times, who runs a fund called the Aquamarine Fund. And I've owned it for something like 22 years. And I've said to him before, this is a 40-year investment. And I'm not saying this as an advertisement for my friend Guy. It's just I'm pushing myself to try to be long-term, to try to say that in a culture where all of us are more and more impatient, right? We're getting dinged by our phones and messages and Twitter and Facebook and all of these things constantly, all of these calls to action. The real superpower is to be able to defer gratification and say, no, in this short-term culture, I'm going to think long-term.
Well, William, coming back to the point that you made earlier about knowing whether one should actively make their own investment decisions or just invest in a mutual fund or with wealth managers. Because interestingly enough, Warren Buffett too is not a great fan of wealth managers. Remember, he famously talked about it in one of his AGMs where he said that 1 to 1.5% commission that you pay to a wealth manager compounds to a big sum over time. How do you circumvent that then?
One reason why I own something like Berkshire Hathaway, which I'm not mentioning as a recommendation, I'm just mentioning that it's something that I've invested in for a long time, is because there's no management fee. Then Buffett and Munger have set it up so that they're being paid a salary of $100,000 a year to manage this enormous company. So they've set it up so that they're not making money off you. They're making money with you. And I think this is a really important thing, is to ask yourself, what are the incentives of the person managing my money? Is their incentive just to make money at my expense? Are they short-term? Are they gouging me with high expenses? Or are their interests aligned with mine? And I think one of the biggest clues to whether their interests are aligned with yours is the fee structure. It's also whether they're honest about their mistakes. Because a lot of people in the investment world, they're so busy spinning and marketing and telling you how brilliant they are. And what's amazing, if you go to Omaha, for example, for the Berkshire Hathaway annual meeting, is the very first thing Buffett and Munger always do is tell you about the things they got wrong. I remember going there one year and Munger saying, we completely failed you by not buying Google. And he said, we also messed up by not buying Walmart. And so what he says is, we need to rub our noses in our mistakes. That's a totally different attitude. No self-promotion, no marketing, no gouging with high expenses. They're just trying to be honest and transparent. And that's a very precious thing. When you find somebody who's really honest, who's looking out for your interests, that's such a precious thing.
Well, yes, precious it is indeed, William, but with all the insightful conversations that you've had, have you managed to crack the code? The code in terms of how to diversify. Is there a formula, the number of stocks one should hold? How should one allocate between certain asset classes? And what about geographies?
I think this is one of the most fascinating questions about investing is how much do you actually want to diversify, for example? And I'm struck by how many different paths there are up the mountain, that there's not one single approach that makes sense. You have to invest in a way that suits your temperament. So I interviewed someone the other day, for example, Francois Rochon, who's a great Canadian investor with an incredible record over 30 years. I interviewed him for my Richer, Wiser, Happier podcast. And Francois owns about 25 stocks. And he said, that's pretty much optimal for him. He said, if he makes a mistake, it's unlikely to be devastating because it's not a huge portion of his portfolio, but it's a concentrated enough portfolio that he still has a very good chance of outperforming. But he pointed out that many of the great investors who he studies, people like Buffett and Munger, would prefer to have maybe 10 stocks. The problem with that is if you make a mistake, it can be devastating. And so then at the very opposite extreme, there's somebody called Joel Tillinghast, who I interviewed also for another upcoming episode of my podcast, who Peter Lynch, the great Fidelity star, once said, Joel Tillinghast is one of the greatest stock pickers of all time. And Joel Tillinghast owns something like 880 stocks. That's just unheard of. The idea that you can have a super diversified portfolio like that and beat the market by the amount that he's beaten is a total anomaly. It makes no sense. But he has certain advantages, one of which is he's probably a genius. He's an absolutely brilliant guy with a prodigious memory and great mathematical skills. he works at Fidelity, where he has a team of 130 analysts reporting and coming to him and saying, look, I think you should look at this stock that's really cheap. So he's at the very extreme end. But I think what's important for your listeners is to say, let me own enough stocks, enough bonds, enough other assets that I'm likely to survive. You need to stay in the game. You need to avoid the risk of ruin. And I think that's one of the great tensions in investing is you want to be concentrated enough so that you can outperform if that's really your goal, if your goal is to beat the market. But I think you need to focus on the ability to stay in the game. And this is something that I think this recent market turmoil, particularly in cryptocurrencies that we've seen in the last few days, it reminds you of these classic principles like margin of safety, which comes from Ben Graham and then Warren Buffett, that you always need a margin of safety because we get things wrong. We make mistakes. There are surprises in life. There's tremendous uncertainty. And so the principle of the margin of safety, which is really about buying assets for less than they're worth, is that it allows you to recover from those mistakes and to survive those mistakes. So I think you use this recent turmoil, whether you've survived it well and flourished or whether it's been really painful, use it to learn this very important lesson that we should set ourselves up to survive, not to be ruined. We must stay in the game in order to win the game.
And William, is India also part of that diversification strategy? How are the marquee investors looking at India at the moment?
My friend Guy Spear, who I mentioned before, has been heavily invested in India for years. And he goes with Monish Pabrai, who's a very close friend of his and who I write about extensively in my book. He goes to India and visits, and I get to hear the reports every time he comes back, which is fascinating. And Guy's impression from his most recent trip a few months back or a few weeks back was that there's just tremendous long-term opportunity in India. That as he would put it, and he's much more knowledgeable about this than I am. He says the fact that it's a country with a young, growing population, that it's going to be the largest English-speaking economy in the world, just gives tremendous advantages to long-term investors in the country. But what he also points out is that there's a tremendous disadvantage for foreign investors like us, which is that it's much harder for us to tell which are really the great companies, which are maybe less clean, where there's a risk of fraud, where they're really looking out for your best interests and where they're not. And so what Guy said is he feels like his friend Monish has a much greater advantage as somebody who knows the market. So I think it makes sense for your listeners in India really to be heavily focused on Indian stocks. You have a great advantage over people like me or Guy. That said, I also think it's really important to diversify. And there is a classic bias in investing that behavioral economists have shown, which is that investors tend to invest at home. They tend to feel like they should just invest in their home country. And that's great. But what happens if your home country was Russia or Ukraine or Cuba? You really do want to diversify. And so I just would encourage anyone who's a serious long-term investor to say, yes, I want to be part of the Indian economy. I want to benefit from this extraordinary growth, from the extraordinary improvements in infrastructure, from the fact that it has this tremendous advantage of being a democracy with a huge English-speaking population, which means it's such a key part of the global economy. But at the same time, let me also diversify, because I think one thing we've seen in the last couple of days with cryptocurrencies melting down is you never want all of your money in one place. As Templeton said to me many years ago, why should you be arrogant enough to think that you can pick the one country, the one fund manager, the one asset class? He said, be a little more humble and diversify. And what he said to me is you should own probably about 5 or 6 funds that expose you to different areas of the market. So always keep an eye on diversification, even when you look at an economy like India and you think, I can't lose here. It's an amazing long-term bet, because we just don't know. We don't know what the future holds. Imagine if you had all of your money in Chinese tech stocks and you were thinking, gosh, this can only go up because we know that China's an amazing growth economy and it has such advantages, and tech is such a great place to be. And Chinese tech stocks have been a catastrophe in the last year. So just diversify.
Well, on that note, William, we'll let you go. It was an absolute pleasure having you here on ET Now. Thank you so much for discussing all those insights and talking to us about how the biggest and the brightest in the investment world are talking about the markets at the moment. Appreciate your time.
Thank you, Anisha. It's been such a delight chatting with you.